My name is Nisha Kohli. I'm doing these valuation series to help budding analysts, college graduates, and working executives to learn how to do corporate valuations. This is my third session. If you have missed my earlier sessions, you can find them on my YouTube channel, Nishfin Consulting. I've come across many executives or MBAs, not in finance specialization though. After a few years in the course of their jobs, they're sometimes presented with valuation models or other finance decisions to take for maybe company strategy purposes. But they feel the need to understand those models to take decisions on financing, negotiating, or entering into joint ventures or looking at the companies for the purpose of mergers, acquisitions, or any other strategic decisions. That's why I thought of doing these series. Please leave a comment if you have any questions. And if you want to do a full course, you can contact me personally through LinkedIn or Nishfin Consulting website. Okay, so in the series, this is the third session. So first session was about the standards, scope, and premises. The second was about the approaches to valuation. So we did about 4 valuation approaches: income-based approach, relative valuation approach, asset-based approach, and then real options. In the third session, I would like to start with the industry analysis and strategy analysis. So what is this about? Valuation is actually neither an art nor a science. While doing valuations, we import concepts from financial theories and apply that to our own stories. So I describe it as, a culinary arts, where to prepare where to prepare a highly presentable, tantalizing dish to the investors or any other interested parties, you have to make right decisions. So, right decisions on sourcing the ingredients, right decisions on the methodology, or right decisions on the proper garnishing material to make it more presentable. So, in this session, we are starting to source our ingredients to prepare our culinary dish. So, the way to source the ingredient is through industry analysis or strategy analysis and financial forecasting. So basically, we are trying to gather the data so that we can apply the methods on that to get the valuation. Okay, let's begin. Business forecasting. Now, to get that business forecasts, what we need to do. Why do we need these forecasts? As we discussed in the income-based valuation, companies are being valued to find the whole method is done to find the intrinsic value. What is intrinsic value? Intrinsic value is the future revenue or future income generating capacity of the company. Now, when we talk about the word future earning capacity, that means we need to forecast the business in future. And as the business is actually, it is not just one entity, it's surrounded by the environment. So what we need to do is we need to get the internal information as well as external information to do those forecasts. So here we are. In the internal information, that can be sourced as like budgets of the companies, marketing plans, projections, the financial statements, the income statement, the profit and loss, the balance sheet, statement of retained earnings and cash flow statements, the audit reports, market analysis reports, etc. And when we talk about the external information can be sourced through various external websites. The best place to get is through the trade association or the industry reports, available at available through different sources like Factiva, the Statista, and so on. There are other good sources like newspapers, online magazines, or other websites. Okay, so this is the information that we can get, but how do we get this information? So we need to know what information we are looking at. Are we looking for the current issues in that business or the industry? Or are we looking at growth projections? If you are looking at the issues in that industry, then we need to set proper keywords, or we need to look at proper reports to understand the issues in that industry, or what are the problems of the industry facing, or what are the requirements for it to start, or to start doing the business or to grow that business. So when it is whether it's okay to expand geographically, to cross the borders and to go into another country and comply with the regulations, etc. So what are we looking at to when we are looking at those, the two parameters with the issues of the growth projections? We need to set proper keywords and we need to look at the right reports. Okay. So how will we find that information? We can find that information if we know the proper industry name and the code. Then we can actually synthesize or crystallize that information by looking at the geographical location. So if we are looking at industry in the Asia, or let's say Asia Pacific region, then we need to look at the reports for that area. Where to find? As I discussed earlier, we can find it on Statista, Factiva, Bloomberg. LexisNexis is a very good source also. Then industry publication, government reports, or databases. Now, when we get this information, we need to be sure that this information is reliable and it's valid. So we cannot just go to any online website and take the data from there for doing the valuation, because nobody will rely on that information. Okay, so once we get the data, we can start analyzing the industry. So we can analyze the industry's past trends, the demand and supply mechanics, the economic forecast, the future outlook. And for that purpose, we can also use industry surveys in addition to the methods, the sources that we discussed above. The outcome of this analysis would be the economic health of the company, what's happening in the industry, what are the current issues, what are the current regulatory features, what are the taxes, and how the competitors or the suppliers are available or not. And those things we can also consider the future. We have to also look at the future prospects of the industry, taking into account the technological changes, especially the disruption that is taking in today's world. So how that disruption affects that industry. One more thing to consider is the credit system within that industry. Is there enough funds available for that, or are the banks supportive of that industry? Sometimes when you approach the bankers or the other investors like venture capitalists or the angel investors, they are looking at the industry per se first before looking at the company. So if, let's say, if you go with a real estate investing proposal, then they may not be interested, because sometimes the markets in the real estate are down. So we have to look at the finances or the credit system within that industry and the influence of other external factors on that industry. Okay, so what are the techniques that we use to do this industry analysis? There are different techniques that we can use, which like the most popular one is Porter's 5 forces and the pestle analysis, SWOT analysis, and industry life cycle analysis. So Porter's 5 forces, it talks about 5 threats to that industry: the threat of new entrants, bargaining power of suppliers, bargaining power of buyers, and the substitute products. So if there are the economies of scale, or huge, let's say if there is huge capital requirement, then the threat of new entrants will be on the lower side. If the government policies, regulations, and the taxes are high, then the new entrants will not be motivated to enter into that industry. If we talk about supplier, if the number and size of suppliers is on the lower side, then they have monopoly, or let's say oligopoly. In that case, they will put pressure or the force on that industry, within that industry. So uniqueness of each supplier's product is also an important force. If the company is able to customize, if any company is able to customize this product and give it to the suppliers, then it's easier to get it done through new suppliers, or to buy it from new suppliers. Then it's a lower force. When we talk about the bargaining power of buyers, if the number of customers are very low, then the force is on the higher side. If the size of each customer order is high, then again the customers have the higher bargaining power. If the differences between the competitors, if there are too many competitors, then it's a lower switching cost for the customers to move to another product. If the price sensitivity is high, even then in that case, the buyers will have a high force because the switching cost is easier for them. When we talk about the substitute products, the threat of substitute product, the more the substitute products available, the more will be the force in that industry. So that the buyer propensity to substitute, relative price performance of that substitute, all these will put pressure or the force on that industry. The last one that we have is the rivalry among existing competitors. So if the competitors are if the intensity of rivalry, or let's say price changing or following the competition, is high, then in that case it's a big force on that industry. So how does that affect your projections? If the force on the industry is high, then the growth projections will be impacted. Then you cannot have upper advantage to have higher growth projections, to keep in mind while doing that. Okay, next analysis is PESTEL analysis. So what does PESTEL stand for? P is for political, E for economic, S for social, T for technology, E for environment, and L for legal. So when we say that we need to do political analysis, so here we do we do analysis of the government policies, whether the government is stable, whether there is corruption in the government. If there's a high corruption, then we cannot estimate higher growth rates. If the foreign trade policy is an open policy or a closed policy, there are barriers to the foreign trade. If there are too many taxes or duties on imports and exports, that will affect the company or the industry. That will affect the industry. Then another one is the labor law and the trade restrictions. That will also impact. So in the economic one, we have to look at what is the economic growth rate. We have to look at the GDP of that country where the business is located, or the where you are planning to do the business. That will affect the growth projections. The next one is to exchange rates, interest rates, inflation rates, the unemployment rates, and so on. So that will affect the economic forecast, the economic outlook, the demand supply mechanism, and all that will affect the numbers that we are going to project. Okay, the third one is the social aspect. So here we consider the demographics, the population growth rates, age distribution, career attitude, safety emphasis, culture, lifestyle, health consciousness, and so on. So if the people are like health conscious, and if the lifestyle attitude is it's different, then you can focus on starting businesses like wellness industry or health industry or medical, biomedical or things like that. So next is technology. So technology incentives, if there are any incentives for implementing technology, what's the level of innovation available in that industry? Automation, R&D activity, technological change, technological awareness. In this one, I can talk about an example of this autonomous cars. So these days, there is a lot of incentive to go for autonomous cars. The companies like Dyson and all, they got into this type of industry. However, we all know that to have this kind of facility, you need to invest a lot. So there's a lot of investment to be done in this sector. Okay, let's talk about the next, weather, climate changes, environmental policies, the restrictions on the operations of the business through different NGOs or the government itself, when they exert pressure that you have to reduce pollution or you have to gain so many carbon credits and so on. So that will affect the growth projections and the cost that we need to incur for abiding by these regulations. L for legal, the discrimination laws. We have the companies or the industry, they have to they have to consider the industry in which it is there. We have to consider the discrimination laws, the antitrust laws, employment laws, then consumer protection, copyright, patents, health and safety laws, etc. Next one is to do the SWOT analysis. So SWOT analysis is divided into two parts. One is internal analysis and the external analysis. So when we talk about the strength and weaknesses, this is about internal analysis, and when we look at the opportunities and threats, that is the external analysis. So what are the strengths? So for when we say internal analysis, for the strength and weaknesses, we look inside the company. What advantages does the company have over its competitors? What advantages it has in terms of its workforce, in terms of the technology, in terms of resources, or location, etc., etc. And then when we talk about the weaknesses, what are the disadvantages of the business, in terms of related to the competitors or related to that area. When it comes to opportunities, we are basically looking at the external environment and what are the opportunities available to formulate or implement new strategies or to increase the profitability. Elements in the external environment that provide the endanger the integrity and profitability of the businesses are threats. So we have to analyze that as well to arrive at the industry and strategy analysis. Next one is industry life cycle analysis. Now this is also important because if the industry that you are looking at, or the valuation, the focal company, and the company's industry, if it is in the introduction stage, then the growth rates that we project can be very high. Even when it's in the green area, the first green area, if it's in the growth stage, then the growth projections could be very high in the initial years that we project. But when the company that we are looking at, the valuations, if that is in the matured stage, then the growth projections that we estimate, the projection that we take into account cannot be very high. So we have to be mindful about the industry's stage. Also, when it comes to mergers and acquisitions, if the companies are in the maturity stage, then it doesn't make sense for the companies to go for acquisitions, because in that case, the companies are already, there can be cultural issues, or if the company is in the maturity state, that means it has reached a saturation level within its own industry. So if the saturation level is there, then consolidation within the same industry doesn't make sense. The investments will not give fruitful results. And if that matured industry goes for other type of products or tries to become conglomerate, or acquire different industries in different areas, then that is also a risk, because then the company loses its identity. So it's a very important analysis to do when we are looking at the evaluations. Okay, next comes the financial forecasting. So for that, the first thing that we use is the pro forma financial statements. So for preparing the projected or the pro forma financial statements, we have to look at the 3 to 5 years past data. Now that 5 years data, 3 to 5 years data, should be converted into common size income and balance sheet statement. And then we also calculate some ratios. While we do that, we use the past data with the help, we convert it to common size and the ratios. Then we apply the forecasting techniques to arrive at our growth projections. So what is forecasting all about? Forecasting is all about looking at the past numbers and then predicting the future. Like in this case, the demand of computers, it's like in January it was lower, it went up in February, and then again, so it's quite going up and down like volatile. So if in the June month it is on the lower side, then we can predict that it will go slightly up, right? So we can predict the demand, predict the sales while looking at the past projections here. What should we consider when looking at the past demand data? So what we need to do when we are looking at, like in this case, we looked at the trend which goes up and down. So these different trends are, can be identified as trends, that is upward trend or downward trend. Then we can also look at the seasonality, that because of one season, in this case the season, it goes up and then goes down and so on. Then there is cyclical element, that the the sales may go up and then cyclically it may come down and so on. Then there is autocorrelation, that happening of one factor leads to the downfall or the growth, of the next term. So there is a correlation with the previous term, so that determines what will be the future. Then there is random walk, that means random variation, we cannot predict that. And that here in this case, we have to mostly rely on the pestle and the Porter's analysis that we did. So we look at the external environment more than the past data. Okay, so the types of forecasting methods that we do are the qualitative methods and the quantitative methods. So when we talk about the qualitative methods, we rely on subjective opinions from one or more experts, and in case of quantitative methods, we rely on data and analytical techniques. So what are these methods? The qualitative forecasting methods are 5 methods here, like the grassroots methods, which we derive future demand by asking the person closest to the customer. So that grassroots, as the name suggests, so we look at the route where the product actually is going. So we look at the customers and what they have to say about the product. So if they feel that the product is good, then we can estimate higher projection or higher demand for that product. Okay, the market research, trying to identify customer habits, new product ideas. So this is a very common method that companies use to predict their demands and predict their sales. Next is panel consensus, when we talk to the experts, a panel of experts. Then we try to derive the future estimation from the synergy of their expertise. And then we can also historical analogy. So we can say that if one product was successful in X environment, then this product can be successful in the Y environment also. So a lot of industries which first originated in the US, they were replicated in different different countries by using this method. So historical analogy. Delphi method, similar to the panel consensus, but in this case we have concealed identities. So the people who are involved, the expertise, we don't have their identities available to us. Okay, so the quantitative forecasting method, there are 3 methods that we can use. There can be more. So these are the popular ones, that is time series models that predict future demand based on past history data. Then causal relationship models that use statistical techniques like correlation, regression to establish the relationship between various items and demand. And then the simulation models that can incorporate some randomness and non-linear effects. Okay, so to arrive, once we get the data, the past data, we can also once we get the past data, we convert that into common size income statement or common size balance sheet. So this is how the common size income statement looks like. When we have the 2 years data, we can use this for the income statement. We use sales as 100% and we convert all items in the income statement as a percentage to sales. So in this case, if 280,000 is the 100%, then 180,000 is 64% of 280,000. So that gives us the cost of sales as 64% and the gross profit is 36% because 100 minus 64. Then the admin and the selling expenses are in the similar fashion. So how does this help? This helps us in understanding that what's the percentage of admin expense to sales. So are we thinking, or are we projecting that the admin expenses will remain at the same level or they will go up or down? Now whether they will go up, down, or they'll remain stable will depend on the company's policy or the decision of the management. Now when we need to actually discuss about this, with the management. Are you planning to keep it stable, or do you think that any improvement can happen in this line of item? So we can and bring that and incorporate that into our projections. Okay, so the balance sheet, I'm sorry about this. This is very, clumsy. It's like too many numbers on this page. But what it means is here we have 3 years data. So each of these years data, the balance sheet data, we have the total of assets and the total of liabilities. So here's the total of liabilities and the equity. What we do here is we take the total assets as 100% and we convert all the items as the percentage to total assets. Now, how does this help? This helps us to understand how, and when we compare it with the past years, like 2014 data as compared to 13 and 12, then we get to know that how the assets have changed, or have there been any investments done in the assets, so they have remained stable. And how do we project that in future? Are we planning to do more investments in any of these in the lines? So when we talk about the current assets will grow, or the percentage will increase if, let's say, the company changes its company wants to sell more, or the growth projections of the company is increasing. Then in that case we might need to have extra of inventory, or we might need to give more credit to the customers. So this percentage will grow. Right. So these percentages help us in projecting the numbers of, the receivables, the suppliers, the inventory. That's why these are important. When we look at the fixed assets, we get the percentages here, and if it is a stable industry, or if we are not projecting very high growth rates, then in that case this will remain quite stable. But if it is a growth industry, if we are expecting to grow, then we might need to invest in capital expenditure. So when the capital expenditure will grow, what we can say here is like, if in 2012 it was 27.25%, in 2013 it was 28.22%, and in 2014 is 29.74%. That means the investment in the plant, property and equipment is increasing. Now the question is, are we projecting higher growth rate? So if yes, then this percentage will be even higher than 29.74%. So this is how the common size statement will help us. We can discuss this in detail when we work with other numbers for the valuation. Okay. Then in addition to the common size statement, the income statement and the balance sheet, we also need to calculate the financial ratios. The important ones are the liquidity ratio. So the liquidity ratio here, we will mostly use the current ratio and the quick ratio. In turnover ratio, we will use receivables, inventory and payable ratio. And those ratios can be also converted into inventory days, receivable days and payable days. So those will be taken into our valuation. Those will be the ingredients for our valuation. Even the leverage ratio, the debt equity ratio, will be used for our valuation purposes when we work with our weighted average cost of capital, or when we look at the financing and the borrowing side. The coverage ratios will be used to understand when we are doing the free cash flow to equity, to work with the interest numbers. And the profitability ratios, again, as we discuss in the common size income statement, the profitability ratios like gross profit ratio and the net profit ratio will give us a percentage figure to apply that for our future projections. Okay. So these we need to work out to start doing our assumptions, or to work with the projections. So defining relevant assumptions. Once we have all the information ready with us, we can actually start defining the assumptions. So a document where the assumptions will be used should be prepared, and it should be clearly stated, so that people whom you're presenting in the end, they all can go through your assumptions Basically, they will know what story you have to tell them behind the numbers. So don't rely on your memory. Tell the audience a more complete story. Tell the audience that you understand your own numbers. Everything affects your cash needs. So what type of company is it? What product? What service? How will you build it? How will you buy it? Whether how will you sell it? The channels, the sales partners, etc. So what type? How many employees will you have to build your company and product or service? So all these to be defined very clearly when you're doing the valuations. Okay, so we have completed the session. I'll see you in the next video. Thank you so much from Nishwin Consulting.